again, the numbers are out, Andrew. Initial jobless claims drops to 250,000. That's 14,000 less than we were expecting, and it's a dozen below the 262,000 that's in the rearview mirror and yet to be revised. And do consider 262,000 last week was the highest level since the second week of November 2021. Now, if we look at continuing claims, also less than expected, but sequentially higher. 1,437,000 follows 1,428,000, and 428,000 last month was the highest level going back to the first week of April. So obviously, this is no exception to that as we continue to comp back to April. So these numbers on continuing claims, switching spots, so to speak, because it's been much more well-behaved. But historically speaking, these are still pretty good numbers. And if we look at Philly Fed, expected down 5, it's up 6.2, up 6.2. That's the best number since April. And we really do need to pay some attention to some of these feel-good indices, Andrew, because we want to see if general activity in various parts of the country is starting to pick up a bit. We do see on the retail sales side, at least that some manufacturing areas of the country are doing better, even though much of our focus, of course, has been on the service sector. Back to you.
Thank you, Rickster. I want to get over to Steve Leisman, who joins us now as well. You're looking through those numbers. What do you think?
Yeah, I think we dodged a bullet this morning, Andrew. There was real concern about this Philly Fed index, and let me explain why. The Empire State, the New York Fed's Empire State Index, it crashed. It fell 42 points earlier this week. It's not an index anybody follows too much, but when something moves like that, there was this fear that manufacturing may have stopped on a dime in the month of August. So this number coming out strong, it's a much more followed index, and the market seems to react to it much more than any other Fed manufacturing survey. Really suggests that we are not necessarily on the cusp of recession when it comes to the manufacturing index. Looking at the details, the employment index was up, CapEx intentions were up, and prices paid were down. So, not a hugely robust number, but considering what might have been, not only that we were looking for a negative number, but the fear of the Empire State one, we did dodge a bullet this morning in that regard. On the jobless claims number, I mean, look, week to week, there's a lot of volatility, but let me explain what I think could be happening in the job market. You had overhiring in some parts of the economy as a result of the pandemic. You have other industries that are still trying to get back to where they were. As these things balance out and hopefully normalize, there's going to be some pops or increases in unemployment. And so what you could imagine is some of the industries that overhired, they may be letting people go. They may spend a time in unemployment, collecting unemployment claims before they can find another job. So the idea that we're at this run rate of 250, not surprising to me, not symbolic of huge softness in the employment, in the job market. But you would think that as this churn happens, there could be some increase. And the idea that it's down and not going straight up suggests maybe the softness in the job market may be limited, at least for now.
Shepard Smith here. Thanks for watching CNBC on YouTube.